Hey everyone, and welcome to Talk Tickers. Today, we're diving deep into Bloomin Brands' latest earnings call. And let me tell you, this wasn't just about the numbers for Q3. Nope. Management rolled out a huge, comprehensive turnaround plan for their biggest name, Outback Steakhouse. This is a pivotal moment for them.
So, let's just jump right to the big number, the one that got everyone talking. For the third quarter, they posted an adjusted loss of 3 cents per share. Okay, but here's where the story gets really interesting. A loss, right? Well, not so fast. That 3-cent loss was actually a massive beat. I mean, management themselves were guiding for a loss somewhere between 10 and 15 cents a share. So yeah, right out of the gate, you can see this was a way stronger quarter than even they thought it would be. And that surprise beat on earnings, it wasn't just a one-off thing. It was really a sign of this positive momentum that's starting to build up across their whole business. It looks like some of their operational changes are finally starting to pay off. So let's peel back the onion a bit. Total revenue came in at $929 million. U.S. comp sales were up 1.2%, but the number you really got to pay attention to is U.S. traffic. It was almost flat, just down at tiny 0.1%. And that, my friends, is a huge improvement. In fact, get this. This is the first quarter since way back in Q1 of 2023, where every single one of their brands, everyone, posted positive comp sales. That's a big deal. Let's zoom in on Outback, the big one. The core brand finally stopped the bleeding. It posted its first positive comp since the second quarter of 2023. And how'd they do it? Well, it looks like it was almost all thanks to their Aussie 3-course value meal. That offer really did the trick, stabilizing their traffic, which, is always the absolute first step you have to take in a turnaround. But you want to know who the real star of the show was this quarter? Carrabba's. I mean, check this out. Comp sales up an impressive 4.1%, and crucially, traffic was actually up 0.6%. It seems like their strategy of hitting both ends of the market, with value deals and then these cool experiential things like wine dinners, it's totally working. They're getting the budget crowd and the special night out crowd. Smart. And the good news keeps coming. Bonefish Grill also got back into positive territory. First time since Q2 2023 for them, too. Management said it was these really specific, targeted promos, things like Martini Mondays that brought some life back into the brand. It's, classic restaurant 101. Find a way to get people in the door on a slow day, and it looks like it's working for them. And just to round things out, you've got Fleming's, their high-end steakhouse. It just kept on chugging along with its steady momentum. This really tells you that the high-end customer is still spending money on nice experiences and catering. It's like a stable anchor for the whole company, which is great to see. Okay, so that's the performance in a nutshell. Pretty solid, right? But now let's get to the main event. The real reason this call was so important. Management spent a ton of time laying out their detailed, multi-year turnaround plan just for Outback. And let's be clear, this plan is the entire bull case for the stock from here on out. So what's the plan? Well, it's built on 4 main pillars. 1, deliver a remarkable dining experience. 2, drive brand relevancy. Remind people they're a steakhouse. 3, reignite a culture of ownership and fun for the staff. And 4, actually invest some money back into the restaurants themselves. This is not just moving the deck chairs around, people. This is a full-on, fundamental overhaul of the entire brand. Now, you're probably asking, okay, great plan, but how are they going to pay for it? And this is the brilliant part. Over the next 3 years, they found about $80 million in savings from stuff that doesn't touch the customer experience. And that money will more than cover the $75 million they're planning to invest in things that do improve the customer experience. It's basically a self-funding turnaround. Pretty slick. So let's look at where that first $50 million for 2026 is going. A full half of it, $25 million, is going straight into food quality. And what does that mean? It means steak. They are laser-focused on improving the center of the plate. The rest of the money is going into marketing, their employees, and just the overall experience when you walk in the door. All right, so with all that in mind, how does this change their forecast for the rest of the year? Well, it's probably no surprise that with such a strong Q3, management felt confident enough to raise their guidance for the full year. Yeah, you can see the change right here. They're now expecting U.S. comp sales for the full year to be somewhere between flat and up 0.5%. And they bumped up the earnings guidance to a range of $1.10 to $1.15 per share. That's a pretty clear signal that they believe they're on the right track. And believe it or not, the outlook for Q4 looks even better. They're guiding for comps to be up between 0.5% and 1.5%.
A big reason for that is they're coming up against a really easy comparison from last year when their promotions kind of flopped. But here's the other big piece of news. In a major strategic move, they're suspending their dividend. They want every spare dollar going towards funding this turnaround and paying down debt.
Okay, we've seen the numbers, we've heard the game plan, so it's time for our take. This is the next call. So, our prediction for Q4, we think they're going to meet or even beat the high end of that new guidance. The momentum they have right now is real, and frankly, that easy comparison from last year is a massive tailwind. We think the market might be underestimating just how much that's going to help.
Now, what about the stock price? Look, expect it to be a little choppy in the short term. The market's got to digest this huge multi-year plan. But the real pop, the real upside, is going to come when they start proving they can actually execute on this thing, quarter after quarter.
And that's why, when you put it all together, we're initiating our coverage with an outperform reading. The strategy makes sense, it's self-funded, and you can see the momentum building in their operations. It's a compelling story. So, with that outperform rating on the table, you might be wondering, how could I play this? How could an investor get in on this potential turnaround?
Well, let's throw out an idea. We'll call it our outrageous but plausible trade.
The idea here is to look at long-dated call options. Think 18 to 24 months out. Now, why would you do that? Well, the logic is that it gives you leveraged exposure to this whole turnaround story, but with a risk that you can clearly define. And that timeline, it's perfect. It gives them time to actually execute on the big stuff, like improving the stakes and changing the service model through 2026 and 2027. Now, of course, there are huge risks. The whole thing could stall out, the consumer could get weaker, or they could just plain fail to execute.
So look, the road ahead for Bloomin Brands isn't going to be easy. For sure, it's challenging, but they have a real strategy in place now. And whether or not they can pull it off, well, that's going to be a fascinating story to watch over the next year and a half. And remember, this is not financial advice.